Hey guys, Ben from Pivot Wealth, and today bringing you the money news in human words. Going to talk about crypto scams, buy now, pay later trap, Queensland property market boom, and the Netflix share price rout. The first thing that I just wanted to cover off is what we've been seeing in markets over the last week. Last week was an interesting one. Capped off the week, markets got hammered at the back end of last week. Although through the week, we saw a number of companies that were announcing their earnings data. That was all received fairly positively. But overall, the numbers, ASX All Ords in Australia finished the week 0.6% lower. S&P 500, the 500 largest companies in America, finished the week down 1.26%. The NASDAQ finished the week down 3.48%. So a significant finishing from a 2.5% loss on Friday. The all-world index bucked the trend and finished 0.69% higher. Crypto mega cap index measuring Bitcoin and Ether down 9.7% for the year to date. Technology, our investment story of the week is technology company BetMakers Technology Group, which is BET on the ASX. They do software data services for the B2B wagering market in Australia. They're up 21% on Thursday, off showing some massive numbers off the back half of their 2022 results. Interesting to see off the back of COVID, I suppose, with football season starting back up, that clearly they're doing something right on that front, and an interesting one to watch over the next little while. Now, the first news story of the week is on this Bitcoin finfluencer who ended up ripping off millions of dollars of investors' money. Essentially, what happened was that he started this guy started a really which grew in popularity, but an online investment newsletter around cryptocurrencies and digital assets. And he provided a weekly newsletter and got a lot of people on the hook, had like 100,000 plus subscribers. Then started talking about this launch of a decentralized bank. He gained people's trust with his education, then took advantage of their desire to make big money and ended up taking these crypto payments, and the bank didn't happen. He ended up having to cop to it, said that he ended up with an opiates addiction off the back of some physical trauma that he had. And that pushed him to make some dumb decisions, and investors, unfortunately, on the hook. So, look, I think that there's a lesson here of being wary of cryptocurrency generally, or cryptocurrency-based investments, whereby, especially with these sorts of things, people are transferring things in cryptocurrency, which is, a bit more sort of anonymous, means that for scammers, for people who are looking to do the wrong thing, there is more of a risk of your money going missing and it being harder for you to track. But I also think there's probably a bigger lesson here about choosing investments, like trying to pick the first decentralized bank, where people are trying to shoot the lights out with their investments and they end up paying the price for that. The frustration here, I think, is that crypto as a sector is really impossible to ignore, but figuring out what makes smart moves here is really confusing, and it can lead to you, like these investors, losing a bunch of money. The opportunity, though, on the flip side, is that if you're learning from the mistakes of others and avoiding making bad decisions, you can avoid some of those problems that set back your wealth building progress. The actions from here, if you're looking to invest in crypto, understand the risk, both of the crypto as an investment, as well as the risks of these platforms and transferring and those sorts of things. And don't let greed force you to cut corners. Then you'd be better placed to get the actual results that you want when you go down this path. The next story that I've got is around Aussies increasing their dependency on buy now, pay later services, things like Afterpay, ZipPay, etc., that have been incredibly popular. Have gone sort of through the roof from a share price perspective. Come back a little bit since their highs and since the Afterpay deal with Square. But look, the headline is that 70% of Australians are living paycheck to paycheck, which is a pretty staggering stat. And more of these people are turning to buy now, pay later as a way that they can access their pays early. They're building this reliance on early access to their income, which what that does is it essentially destroys your ability to be able to actually get ahead financially. Saving money is one of the first building blocks of getting ahead financially. So spending less than you earn, finding some money that you can put aside to save and invest. But if you're not only not saving, but you're also spending money ahead of you actually earning it, what that means is that you're starting 2 steps behind. So the result is that you end up not making any progress at all building your savings and investments, and it can be a really frustrating and a really stressful journey. The opportunity, though, on the flip side, is to break this cycle and to really get on the front foot with your savings. Actions here is to make this happen, like especially if you're stuck in that sort of vicious cycle, that you want to really prioritize the spending that's just the spending that's most important to you. That's different for everybody. But when you do that, it allows you to save more money. This way, you'll be able to actually build some better habits. And these are habits that will serve you not only to get out of the buy now, pay later cycle or to get into the savings habits, but it will serve you for years into the future. I think money is like a muscle that you build over time. So the earlier you start to learn to flex it and build that muscle, the better you're placed for the future. The next article that I've got is on the Queensland property boom that we're still seeing. The Queensland property market is continuing to soar despite what we're seeing in the slowdown in the New South Wales and Victoria property markets. Last month, we saw 1.9% growth in Queensland property, which is a huge amount for 1 month's for just a 1 month period. And the market was surging ahead of New South Wales and Victoria, who had actually gone a little bit backwards. So what that actually means, why is it important? Well, for people that are looking to buy property in Queensland, it means that you're staring down the barrel of potentially paying more for your property as the market is rising over time. That feeds into the bigger challenge of would-be property buyers struggling to keep up with the huge growth that we've seen in property prices throughout 2021, probably even a little bit before that. So the opportunity for Queensland property buyers, if that is the next move for you, it's to get into the market now before prices rise further. The actions from here that you can take is to make sure that you've got a rock solid game plan in place where all of your bases are covered. And that way you're going to be able to take really confident action when you do go to enter the market. You're talking about, 6 or 7 figure decisions. These are hard ones to do. They're hard ones to do if you're not having the confidence that you know that you're not heading for big trouble down the track. The next article that I saw was about the Netflix share plunge. Over $50 billion of value, US dollars, were wiped off the value of the Netflix share, Netflix company last week through their share price. Basically, Netflix had anticipated a forecast in their subscribers of over $2 million extra, extra to $2 million, 2 million people rather. So, sorry, Netflix had anticipated an increase in their subscriber base of 2 million people, but that what they actually experienced was their first decline in subscriber numbers of about 200,000 people. Why that matters? Well, it shows that tech overall as a sector is still quite shaky, and that for companies that aren't really delivering on investor expectations, that they're going to really quickly pay the price, and the price is going to be a serious whack. Now, the frustration I think that this one talks to is the fact that when you want to invest, it's hard to know what the right moves are. It's also really confusing to understand what the market is actually looking for. And this I speak to a lot of people, especially people that work in and around tech, that you go, oh, well, this company's doing really well because they, did this conference and they're doing these things, and we see their website looks really slick. But the analysts are the ones that are dictating the share price for the big cornerstone investors. And when they're anticipating their, certain share prices or whatever, or market subscriber numbers, then the market needs to deliver that, or the company needs to deliver that, or the market is going to tell them what it thinks. So the opportunity is that you avoid the stress and invest for reliable, consistent progress. So I think that one of the actions that you could take here is just in investing into the share market itself, just backing the index, the boring old market index, or even the index with a bit of borrowing on top, like a geared fund or something like that. That avoids all company-specific risk and means that you can avoid this noise. It all just becomes white noise, means that you're profiting to the seriously solid levels that we see from the actual share market over time. And looking at those numbers, the numbers are good. So you avoid a lot of stress, you get better progress, and you avoid those challenges and mistakes. The next one that I saw is the article that I've got is around Elon Musk and his bid to acquire Twitter. Basically, the Musk is end up in this serious battle with the Twitter board adopting a poison pill defense, which essentially is a strategy that allows the company to issue a heap of new shares at a deep discount, which makes it harder for would-be takeover people like Musk to take over the company. What that means for investors and what it means for you and your money, it means that it shows that there's a challenge in getting deals like this done. That if you're investing in a company, even if it's a good company that is attractive, that other people want to go in and swoop in and pay, way over the odds, which is what the Musk's bid for Twitter was about. It means that you're not necessarily going to be able to benefit from that. It highlights the complex nature of these single stock investments. So I suppose that the frustration is that people would have seen Musk buy the share price at a way above market, but instead of being able to take advantage, what you're doing is you're getting dragged into the boardroom politics. Again, frustration and stress. The opportunity, though, is to have their shares bought at a premium from takeovers like this, but this is at risk. So the action here, when you do decide to invest into single stocks, if you go down that path, that you want to understand that there's a lot of things that can impact your investment that aren't always clear. Even if you have a good company that's undervalued, the complexity can impact the payday that you do get or that you have available to get from your investments. The next article that I have for this week is the more than doubling of the government places for first home buyers to buy property with only a 5% deposit. This is through a big scale expansion of the first home loan deposit scheme. Basically, the budget measure has increased the places in the first home buyer guarantee scheme from to 50,000 places each year from 20,000, so more than doubling. Why that matters is that it reduces the need for an average deposit by $150,000, which is huge, on the average property in Australia, meaning that for first-home buyers, it should be able to get into the market. That potentially has some interesting flow-on effects for property prices. I know there's a lot of talk about artificially inflating different pockets of the market, which is something that you should really be aware of if you're buying property at all or entering the property market, and in particular, if you're a first home buyer looking to access this scheme. The frustration is that on the other side, that saving a deposit and saving a huge deposit like what's needed to get into average property prices around Australia is a really, really big deal, and it can seem like chasing your tail. So this strategy can be a potential circuit breaker. The opportunity is that this can help you get into the market faster. And even if you do already have a deposit or close to having a full deposit at 20%, it means that you can hold on to your cash as an emergency fund or for other investing, meaning that you've got peace of mind instead of just having to push, say, this huge chunk of cash and then just give it all away as a deposit to get into the property market. The actions from here, because this is quite a complex one and it's with risks and trade-offs on each side, get a good broker or a good financial advisor to step you through this so that you can understand the rules and ultimately make it happen faster and easier.